Welcome back to the Deep Dive. Today, we're really getting into the weeds on the latest from Equity Bank Shares. That's ticker EQBK.
Yep.
Their Q2 FY25 results just landed. And honestly, there's a pretty interesting story kind of bubbling under the surface of those headline numbers. I felt we had to unpack it for you.
Absolutely. And our mission, like always, is to cut through, all the noise from the earnings call itself, the transcripts.
Right.
We'll zero in on the key bits, the main numbers, what management's actually thinking, and how the market took it all without getting lost in the tiny details.
Think of it as your shortcut to getting really informed.
Exactly. Your expert guide.
Okay, so let's jump right into those top line numbers for Q2, because this is where the market reaction really started.
For sure.
Equity Bank Shares reported revenue of $58.4 million, and GAAP EPS was 0.86 cents.
Mm-hmm.
Now, if you follow these things, you'll know both of those actually trailed what analysts expected. Consensus was $60.5 million for revenue and $0.89 for EPS.
A miss, a clear headline miss. You can't really ignore that.
No.
But if you just peel back one layer, there's some, let's say, hidden strength. Despite those misses on revenue and GAAP EPS.
GAAP being the official reported profit per share, yeah.
Right, generally accepted accounting principles. But their core net interest margin, that actually showed some real muscle. It widened 10 basis points sequentially.
Which is pretty decent.
Yeah, up to 4.17%. And a basis point, just quickly, is 0.01%. And here's where it gets, really interesting. Adjusted EPS.
Which strips out the one-off stuff.
Exactly.
Right.
That was buoyed by the NBC Oklahoma integration, and it actually hit 94 cents.
Okay.
But like you said, the market's first reaction, it definitely focused on those headline misses.
Oh, absolutely. That sentiment played out really clearly in the share price, didn't it?
It did.
The stock closed at $44.06 before the call, dropped to $41.14 the next day.
Wow, yeah.
That's a 6.6% drop on nearly 4 times the average trading volume. That's a pretty sharp reaction.
It really is. It's like the market saw, one cloud and decided a hurricane was brewing, even after the stock had a pretty good run just before.
Yeah, it shows how sensitive things are right now.
Definitely.
Okay, so with those headline numbers and that dramatic market reaction as context, let's pull back the curtain a bit. Let's get into management's strategic vision.
Yeah, what are they focusing on?
Because there's more here than just the first numbers.
Mm-hmm.
What did CEO Brad Elliott point to? What are the key drivers, especially with that NBC Oklahoma merger?
He was pretty straightforward. On the call, Brad Elliott really hammered home those expanding margins we just mentioned.
Okay.
And he highlighted the, frankly, seamless integration of NBC Oklahoma. That deal closed July 2nd, and notably, it was within 60 days of being announced.
60 days, that's fast for a bank merger.
It really is. And this quick turnaround on M&A, mergers and acquisitions, it's actually like a core skill for them. It's not just a one-off. It's in their playbook.
Right. And he also reiterated their full-year guidance, didn't he? Specifically for loan growth and stable credit costs.
He did.
Do you think that guidance stability was actually enough to calm the market's initial fears? Or was it more just a hold-the-line message?
That's a good question. I think it definitely tempered some of the fear. Management saying, look, despite the miss, we're sticking with our full-year plan. That signals confidence.
Mm-hmm.
It suggests they think the underlying business is strong. Probably stopped an even bigger sell-off.
But maybe not enough to completely turn sentiment positive.
Right. The market, it seems, still wanted those, cleaner beats you see from some other regional banks right now. Less noise.
Okay, let's dig deeper then into the actual financial performance breakdown.
Yeah.
You mentioned that adjusted earnings figure at 94 cents. What exactly got adjusted out compared to the JAPO at 86 cents?
Good point. So that $1.94 adjusted number, it specifically excluded costs from M&A, merger integration expenses, and also some charges related to paying off debt early, debt extinguishment.
Got it. One-time costs, essentially.
Exactly. Peeling away the non-recurring stuff to see the core operating performance. Net interest income was $49.8 million for the quarter. And that actually showed an increase from the prior quarter, even after you adjust for some financial benefits they had back then.
So the underlying trend in their core lending profit is up.
That's the takeaway, yes.
And that improvement in net interest margin, the 4.17%, that's not just luck, right? It's driven by how they're managing their balance sheet.
Precisely. They've been actively remixing things. Loans now make up 76% of their average earning assets. That's up from 75% last quarter.
So more money working in higher yielding loans.
Exactly. And they're getting better yields on that loan portfolio too. It's a proactive strategy to boost profitability. Plus, non-interest income also ticked up sequentially.
Living by fees.
Yeah. Customer service charges things like deposit services, treasury, debit and credit cards, mortgage banking, trust and wealth management. It shows they're not just relying on loans.
Okay. You also mentioned debt extinguishment charges, a $1.44 million hit to redeem some outstanding subordinated debt. What's the thinking there? Why now?
It's basically a refinancing move. Management said it gives them continued capital flexibility, it keeps their overall capital strong, but importantly, lets them secure a better coupon, a better interest rate on new debt eventually.
So a strategic cost optimization for the long run.
That seems to be the plan, yeah.
All right, but let's shift to something that maybe caused more concern for investors, asset quality. What did the call say about that increase in non-accrual loans?
Yeah, this was definitely a key discussion point. Non-accrual loans, those are loans where the bank isn't really expecting interest payments anymore.
Due to borrower issues.
Right. They closed the quarter at $42.6 million. Now, that's up $18.3 million from the previous quarter, which sounds like a lot.
It does.
But it was almost entirely driven by one single relationship, a quick service restaurant or QSR relationship they actually talked about before.
Oh, okay. So not widespread issues, but one specific known problem.
That's how they presented it. And they did note some general softness in the QSR sector, but said their portfolio beyond this one case is pretty granular and diversified.
And management said this QSR customer has a path forward. They're working on it.
Yes, they indicated there's a clear plan for the customer to exit underperforming locations over the next few quarters, and that the bank is actively involved, collaborating towards a full resolution.
So why classify it as non-accrual now?
They clarified it reached a point where, from an accounting perspective, it was the appropriate classification, not necessarily meaning it's a total loss or a complete failure, but more about transparency at this stage.
Got it. Accounting rules kicking in.
Seems like it.
And what about the bigger picture on asset quality, beyond this one QSR loan?
That's important. Total classified assets loans showing potential weakness were $71 million. That's still well below their historical averages.
Okay, that's context.
And net charge-offs, the loans they actually wrote off as unrecoverable, very low. Just 6 basis points annualized for the quarter. Tiny. Credit quality across the rest of the portfolio looks stable, below historic levels. They credit their disciplined underwriting. So yeah, the QSR thing looks like an isolated challenge they're managing, not a sign of systemic rot.
Good to know. Okay, let's pivot to growth then. Loans, what's the story there?
Well, loan balances year to date are up a decent $100 million, and new loan production in Q2 alone was $197 million.
That sounds strong.
It is. It's double what they did in Q2 of 2024. And the interest rates on these new loans are attractive, around 7.17%. So they're adding value, they're accretive.
Okay, strong production. But wait, ending loan balances actually went down slightly. How does that work?
Yeah, it's a bit counterintuitive, right? The decline was due to a couple of things. Lower line utilization, so businesses drawing less on their existing credit lines, and also increased payoffs.
Payoffs, is that bad?
Not necessarily. Management actually framed these payoffs as positive outcomes for the borrowers. Maybe they sold an asset or got refinanced upstream by a bigger bank, and they expect to get future business from these clients.
So healthy churn, not necessarily lost business. That's
the narrative. And the future pipeline looks strong. Their 75% pipeline loans very likely to close is at $481 million. That's up 33% from Q1. So growth potential is there.
What about the other side of the balance sheet? Deposits. Are they holding up?
Well, deposit balances, if you exclude brokered funds.
Right, the less sticky institutional money.
Exactly. Those balances did dip by $43 million, mostly in commercial accounts, which management put down to normal outflows, typical business activity.
But the accounts are still open.
Yeah, they emphasized the accounts remain open and active, so it wasn't customers pulling everything out and leaving.
Okay. And their capital position, how solid are they? Can they handle this growth and any potential bumps?
Seems very solid. Their TCE ratio finished the quarter at 10.63%.
TCE being tangible common equity, a key measure of that capital cushion.
Right. Strips out intangibles. And 10.63% is a really robust number, shows resilience. Tangible book value per share, another key metric, was $32.17, also solid.
And that capital they raised last year.
Still sitting at the holding company level. They haven't pushed it down into the bank itself yet. Gives them strategic flexibility.
Okay, so looking forward, what's the expectation for margins and potential loan losses?
They anticipate maintaining margins on their existing legacy portfolio. That's helped by loan growth and just, older, lower rate loans continuing to reprice higher.
Makes sense.
And crucially, they expect margin improvement from the NBC Oklahoma deal as they finish the fair value accounting for the assets and liabilities they acquired.
Which often gives a nice accounting boost initially.
It often does. And for potential loan losses, the provision they're forecasting a pretty conservative 12 basis points of average loans annualized.
All right, so let's zoom out again. Investor context. What was the feeling around this call compared to maybe some other regional banks?
Well, the call definitely highlighted a cautious mood among investors, especially when you compare EQBK to peers like, say, BOH or FFIN, which had what the market perceived as cleaner beats.
Meaning they hit or beat expectations without many caveats or adjustments.
Exactly. So while EQBK's margin improvement was noted, those headline misses on revenue and GAAP EPS really overshadowed it. That's what seemed to drive that initial sell-off we talked about.
And this came right after the stock had rallied pretty well, too.
It did. Shares were up about 15% from early June after the NBC Oklahoma deal closed. So this earnings reaction basically wiped out a third of that recent gain.
Ouch.
Yeah. And it follows a pretty volatile 6 months anyway. The stock's been bouncing between $33 and $51, lots of nervousness around interest rates and regional bank stress.
So given all that, what's the latest on their M&A strategy? Still active?
Very much so, according to Brad Elliott. He mentioned conversations are ongoing. He actually attributed a lot of the activity to the age of ownership and management in the banking sector.
Meaning older bankers deciding it's finally time to sell.
Pretty much. After years of holding off because of COVID, then the low rate environment, now decisions are being made. And equity bank shares. They're focused on deals between $250 million and $1.5 billion in assets within their current geography.
So looking for deals that move the needle but fit strategically.
That's the idea.
Okay, and one more specific point, they talked about Wichita, Kansas, right?
Yeah.
Given the news around Boeing and Spirit Aerosystems there, any major exposure?
They addressed that directly, said it's minimal. Less than 10% of their total loan portfolio is in the Wichita market.
Okay.
And less than $5 million in direct exposure specifically to aircraft industry suppliers. They feel the impact from Boeing Spirit issues is limited for them because other aviation companies there like Cessna, Beechcraft, Learjet are still seeing strong demand. It diversifies the local risks somewhat.
Got it. Helpful context. Okay, now, let's shift gears for our final segment, the part where we maybe stretch things a little.
Get a bit creative.
Exactly. This is our not financial advice segment. We pitch an outrageous, maybe, but potentially plausible trade idea based purely on what we've just unpacked from the call.
All right. Well, considering how the market clearly preferred those regional banks with the cleaner beats.
Like BOH or FFIN you mentioned.
Yeah, right. And given EQBK's initial stock underperformance right after earnings, here's a thought for you. A relative value pair trade.
Okay, explain that.
You'd go long buy shares of a regional bank like BOH or FFIN, one that showed strong execution and got positive feedback from investors. And at the same time, you go short bet against EQBK.
So betting one goes up relative to the other.
Exactly. The idea here isn't necessarily that EQBK is a bad company long term. We've seen their fundamentals have strengths. It's more a bet on the persistence of this relative underperformance, at least in the short to medium term.
Until when?
Until maybe that QSR credit issue is completely resolved and looks clean on the books. And until the benefits from the NBC Oklahoma merger show up clearly in the main reported JAP numbers, not just the adjusted ones.
So you're betting the market will keep penalizing what it sees as messiness.
Pretty much. Even with management giving reassuring guidance, it's a trade based more on current market sentiment and how investors react to complex stories versus simple ones, rather than just a pure bet on the underlying fundamentals alone. Outrageous, but plausible, maybe.
Definitely makes you think. Okay, so let's wrap up our deep dive on Equity Bancshares Q2 earnings call. It really was a mixed bag, wasn't it?
It really was. Headline misses on revenue and JAP EPS that clearly stung the market.
But underneath that, you had strong core net interest margin expansion, solid adjusted EPS, boosted by that quick NBC Oklahoma integration.
Yeah, and the market reacted cautiously, focusing on the misses, even though management stuck to their full-year guidance and highlighted that M&A skill they have.
It's a perfect snapshot, really, of a bank navigating today's complex regional banking world.
Absolutely. Balancing organic growth, strategic deals, while also dealing with very specific credit issues like that QSR loan. It shows how banks operate with both, tailwinds and headwinds constantly swirling.
Well said. And remember, everyone, this discussion, it's purely for informational purposes, definitely not financial advice.
Please do your own research.
Always. Consider multiple viewpoints, challenge what you hear, including from us. Now, what really stood out to you in all this? What questions are you left mulling over? We genuinely love to hear your thoughts.